Hello, good afternoon, everybody, and welcome. Thank you so much for tuning in to our CFA Society San Francisco webinar today. I am Ann O'Brien, CEO of the Society, and I have the pleasure of introducing our august panel. Before I do that, I'd simply like to mention that you'll be muted for the webinar, so we invite you to ask your questions in the Q&A box on your screen, and we'll endeavor to answer as many as we can. Our event today, AI-powered sustainability, seizing investment opportunities for 2024, is sponsored by Clarity AI, with whom we worked to co-create the content. Thank you for your sponsorship, Clarity AI. It is now my pleasure to introduce our two panelists. Gregory Van Drugenbrock, Director and ESG Data and Analytics Lead at Lazard Asset Management, joins us from New York. Marçal Gavalda, Chief Technology Officer of Clarity AI, is joining us from Davos, Switzerland. Gregory and Marçal will be in conversation on a spectrum of AI topics with our moderator, who is Raj Mangani, CFA, Managing Partner, Top Seeds, and a member of our CFA Society San Francisco Board of Directors. And he joins us from the Bay Area. So we're quite an internationally diverse panel, as well as group of attendees tuning in today. So Raj, I'd now like to turn the webinar over to you. Thank you.
Thank you, Anne. And welcome again, everyone. We are delighted that you've decided to join us. We're joined by two esteemed panelists who operate at the intersection of AI and sustainability. And what we are going to discuss with them today is how AI can help investors become more aware of the pitfalls, address some of the challenges, and create new opportunities for including sustainability considerations, whether that be tackling climate change, preserving biodiversity, building better boards, or addressing modern slavery as part of the investment process to not only create a more sustainable world, but better risk-adjusted portfolios over time. So let's launch right in. Let's start off with some definitions. Greg, if I can come to you first. How would you define sustainable investing, or put it differently, what is the sustainable investing framework in terms of measurements, actions, considerations that investors are and should incorporate in their decision-making process?
Thanks, Raj. Thanks for having me here. So the way I think sometimes about my framework for sustainable investing is I think of it in 4 stages. From the most simplistic exclusionary screen, that came about because of certain investors having ethical considerations with respect to not wanting to have any type of exposure to controversial activities, sectors, industries, teams, sometimes even events. So think of like exclusionary screens on tobacco, alcohol. But over the last years, you've also seen more, environmental factors, such as maybe wanting to exclude shale gas, shale oil, thermal coal, etc. So that's really the simplest one. Then you go a little bit more, you go up in level of complication, and then you have ESG integration. So ESG integration is probably the most spread out there. That one looks to effectively integrate material, environmental, social, and governance factor in the investment process. So I think the easiest way to think of that is, investors will use, for example, ESG scores, either in a systematic way or in a fundamental way in their investment process. One way to sometimes think about this, like a simple example, say you come up with a score that will measure, how weak or how strong governance is at a company. If, a company has weak governance, maybe you'll have a higher discount rate. So that's an example of a simple use case. Then the next one is impact investing. And so now we're kind of moving away of, exclusionary screen negative filters, maybe more into the positive filter. So in impact investing, you're effectively trying to gain exposure on companies that beyond financial performance will also have a positive contribution on the environment or on society. An example there is you'll see quite a lot of funds that use the SDG, so the UN Sustainable Development Goals, one of the 17, as an impact metric. Two famous ones are climate action, so investing in companies that have a positive contribution to climate change, at least in reducing climate change, or for example, gender diversity. And then last but not least, I would call out thematic investment. Thematic investing. Thematic investing obviously is broader than sustainable investing. You can have crypto thematic investing, but within the ESG space, typically what you're looking at is funds that try to play into a trend or a theme that is there due to structural shifts in society or the environment. So two very good examples are the move to a more sustainable agriculture. Another example is investing in the supply chain that is necessary for climate adaptation and mitigation. So, for example, clean energy materials, which are necessary for the electrification of the grid.
Yeah, so thank you. Thanks, Greg. So, some people, tend to think of sustainable investing and ESG investing as really one and the same. Are they the same, or are they really different, and if so, how?
I kind of prefer the sustainable investing terminology. I think it's more broader. I would call ESG investing just a subset of that. I think of ESG investing very much as ESG integration, the integration of environmental, social, and governance factors. So yeah, I will qualify it as a subset.
Great. So thank you for that clarification, Greg. So staying with you, one of the drivers of adoption of sustainable investing has been, regulation. Right? So perhaps you can lay out some of the critical regulatory initiatives and how effective are they?
I don't know if I fully agree with that. I think it's a little bit of both. I think because of the, because I think you have an increasing amount of AUM under ESG, I think the regulators are also getting concerned about potential greenwashing. And I know that we'll be talking a little bit about that. But yeah, regulation is definitely something. I mean, when I speak on the street with peers that work in ESG, I think all of us have to admit that we'll probably spend a little bit more time in regulation than we would like to. The one thing I would say before I start kind of giving you a little bit of a checklist of what type of regulations are out there, is to say that within the financial industry, as investors, as asset managers, we tend to be myopically focused on regulation that impact us, impact our workflow, impact our compliance processes, etc. But it's actually not those regulations that will have the biggest impact on the investments we make. But that being said, because they impact us most, I'll give you a quick outline of what those are. I have my own personal framework on how to classify different regulation, financial markets regulation coming from the SEC, coming from ESMA and whatnot. And that is basically, in my opinion, they fall in three pillars. One is disclosure. So clearly the regulators over the last years are trying to make sure that there is more standardization in reporting, that there is, effectively creating a level field so that we can more easily compare investments, look at ESG performance of investments. So from disclosure perspective, I would say two things. In Europe, for example, you have CSDR. Pretty much every single public company and some of private companies will have to report non-financial factors next to their financial metrics. The other thing I would say is TCFD fully integrated into ISSB. So we do have accounting standards now that take into account environmental factors. So those are two big things. So you're going to see a lot more data, much more standardization in corporate reporting. As a consequence of that, we asset managers can take that data and obviously use that in our research. But on our end, we also have disclosure requirements. For example, the sustainable finance disclosure requirements in Europe basically force funds that are marked as ESG, if we want, and that are marketed in Europe or in the UK to basically report certain metrics, sometimes referred to as principal adverse indicators. So if I have a fund in Europe, I have to say what the average carbon intensity is of that fund, or I have to report on that. So that's disclosure. And then the two other elements, maybe dwell a little bit less on them, is the second element is creating a level playing field of what is actually a sustainable investment. Right? Everyone can say, I have a sustainable investment here. So the best example of that is the EU taxonomy framework in Europe. And it's something that you're starting to see similar frameworks across the globe now emerging. And that is basically a definition that is science-backed. So they took a bunch of scientists and they said, okay, what type of activities positively contribute to climate adaptation, climate mitigation, biodiversity preservation, etc. And then these activities, if they meet certain screens and certain technical criteria and whatnot, can be considered as sustainable. So that's a big one. And what the regulators is trying to do there is effectively, by coming with a framework, trying to make sure that there's, maybe more capital that flows into those sustainable activities, reducing the cost of funding, and therefore, pushing forward adaptation and mitigation. And then last but not least, which I won't drill at all on, is you're starting to see increasing prudential requirements around integrating climate risk in your risk management framework. So we have a little bit of that on the asset management side with TCFD, but definitely on the sell side, a lot more, risk managers now effectively have to look at climate risk as well, beyond their traditional risk metrics.
Fascinating. Thanks, Greg. So now let's bring AI into the conversation. So Marcel, thank you for joining us from Davos. You've been in the technology industry for a number of years. Before we get into use cases and the role of AI, maybe just for the sake of our audience, just demystify all these buzzwords: AI, machine learning, data science, big data, right?
Yes. Yeah, happy to, Rajan. Hello, everyone. I'm very happy to be able to talk to you from Davos. I'm usually based in Atlanta, but this week I'm with the CEO here together at the World Economic Forum, where in fact, the two of them key topics are artificial intelligence and climate. So very relevant topics that are being discussed. Now, my parents were teachers, so I think it's a good idea to start. There's a slide, I think, in the handout that if it can be shared, just to kind of make sure that we're all on the same page in terms of all these sort of buzzwords and definitions. So let's start with data science, which really is statistics, right? So statistics and probability, this idea that from numbers we can actually, there's some regularity and rules that emerge. And so this is kind of the oldest discipline, data science. And then a few years ago, with the advent of the internet, there was this buzzword of big data, which is basically statistics applied to very large data sets. Now, at Clarity, we do have a data science team. And one of the examples that we use with regards to data science or more traditional statistics is the ability to have very robust scoring and prediction intervals for a variety of metrics. As Greg was mentioning, there's all these raw data around emissions, water usage, hazardous waste. They all come with different sort of ranges and units. But then you want to aggregate these data. So you want to have kind of a mathematically sound and statistically sound way of doing this aggregation. That's an example of data science. Now, another important area is machine learning. Machine learning is basically a class of algorithms that have the characteristic that they learn from examples. Instead of having to program exactly how something should behave, these models are able to learn from examples. And a subset of machine learning is deep learning, which was also a buzzword, just a few years ago, because deep learning are ML models that are specifically good at perception tasks like speech recognition or vision, sort of image understanding. And actually, that's exactly my background. I was, as a child, already interested in languages, and then I studied computer science to basically be able to have, apply computers to aspects of understanding human language. And the way to do that is through these machine learning models. And you have this very interesting characteristic that they're inspired by how our human brains actually work, in the sense of getting a lot of inputs and then computing some activation function. So natural language processing can also be seen as a subset of machine learning, where it started doing simpler things like information retrieval. If you think about the Google of early years of Google, then a little bit harder tasks like sentiment analysis, whether something is positive or negative, then getting it to a harder task like question answering, and then we will jump into where we are now with AI. But an example of more traditional machine learning at Clarity is how we estimate unreported metrics, because something quite interesting is that there's many companies that report maybe some metrics, but not all, but based on the type of industry. And not only that, but based on specific attributes of that company, such as number of employees, geographic distribution, etc., we're able to compute very accurate estimates of certain metrics like emissions or other types of metrics. So for that, we use the more sort of traditional machine learning models, as opposed to kind of the buzzword of the day is artificial intelligence, AI, which you can think of it as the umbrella term for any task that was thought that only humans could do, right? And so things like playing chess. Now, this is, long ago, Deep Blue already took care of that. Driving a car, we're getting there with self-driving cars. Carrying a conversation, we're now there, right? So this has been kind of a long dream of a lot of AI researchers. Now it's a fact with the likes of generative AI models and large language models. So generative AI is when you have a model that creates human-level text or images, and specifically LLMs are these models that are trained on the entirety of Wikipedia and additional data that are then able to demonstrate sort of human-level capabilities in certain still fairly narrow areas, but at developing quite rapidly. And we're using them at Clarity, but something that we'll also discuss is we have a judicious application of these models, because as you may already know, if you follow a little bit of this sort of buzzword and trend with LLMs, there's this problem with hallucinations and the fact that they're not really necessarily grounded in verifiable information. And so the way that we use LLMs right now at Clarity is in the narrow task of helping us extract quantitative and qualitative metrics from documents such as sustainability reports. So I hope this makes it a bit more clear. So AI is umbrella term, and then there's machine learning, data science, and I'd be happy to also answer any questions from the audience.
Great, thanks, Marcel. That was super comprehensive. So just staying with you, I mean, do you see AI as truly transformative when it comes to sustainable investing, or is it about driving, say, efficiencies in the investment process for sustainable investing?
Right. I do think that in general, sort of generative AI is a transformative technology that will have as big as an impact as the advent of the internet or client server architecture or the mobile smartphone revolution. We're now at the very early stages of that. And so it's a little bit like asking, maybe 20 years ago, what is or 30 years ago, beginning of the internet, like how is the internet going to affect your business or society? Well, we don't quite know. We think it will be, but you start by communicating via email. That was kind of a new thing. And then there's e-commerce, right? And then now we're having a Zoom call. So I do think that generative AI will be very transformative, not just for sustainable investment, but for society at large. The key thing is to kind of learn how to use it and help develop it.
Great, thank you. So let's switch gears a little bit. Where the rubber meets the road for investors is, how does all of this technology, right, matter when it comes to portfolio construction and management, right? So Greg, maybe starting off with you, right? Sustainable investing, AI, right? Almost all of this sounds, too good to be true, right? One of the criticisms, even though you're here trying to create a more sustainable world, one of the criticisms is that this sustainable investing often comes at the expense of short-term returns, even though it's expected to pay off in the long term. Do you agree? And does it matter, right?
It's a loaded question. I think, look, my personal perspective is that at the end of the day, we went through the different stages of, sustainable investing, right? If you look at, we went from exclusionary screen to impact investing. And so I think depending on how you integrate ESG in your investment process, it can be a constraint, right? Like exclusionary screening. If you put so many exclusionary screens that you can only invest in healthcare, at the end of the day, that could have effectively an impact on short-term performance. That being said, though, I think, when I look at the different ways you can integrate ESG, some of it can be constraining, some of it can be risk mitigating, certainly when you look at ESG integration, and some of it can be alpha generating. So just to talk a little bit about that last one, because we didn't speak too much about, when we were talking about regulation, we were effectively focused entirely on the regulation that are impacting our industry, right? The disclosure, more data, putting more management. But the reality is, when I talk with the fundamental analysts, the regulation they care about is the IRA, the Green Deal in Europe. These are regulations that are transformative in the sense that they can generate new business models and probably destroy some other business models. And so will have an impact on their investment. And so being aware of those type of regulations, can be alpha generating on the long term. So that's where, it really depends a little bit on how, naive how broad your definition is or how narrow your definition is.
Right. No, that's some great insights there, Greg. Just, if I'm an investment professional, right, what data and approaches would you recommend to me as far as creating portfolios within a, sustainable investing frame, right?
So it's a good question. And, one is you'll need time. Data and analytics is not enough. But, if let's say tomorrow you land into the ESG space and you're the head of data analytics, you're going to need a toolbox of some data and analytics. And I'm just going to give you a quick checklist. And then I'll talk a little bit about some of the pitfalls of that data. So the first thing I would say, we talked about exclusionary screens. You're going to need some product involvement data and some norm-based research on controversies, because that's just an expectation level of your customers. They will be like, I don't want to have tobacco, I don't want to have alcohol, I don't want to have shale gas, I don't want to have Arctic oil drilling. You need to have, processes around that to check that, even from a compliance perspective, right? The second one is, I think when people get into ESG investing, to use ESG investing actually right now, we think about ESG integration. So everyone goes and look for maybe some scores that they can use. And maybe if you start, you don't want to build your own score directly. So what you look for is a third-party score. And what you'll quickly find out is that different third-party scores have different methodologies. Some contain ops and conduct. Some look at ops and conduct and products and services. Some are a risk rating. Some is a performance score. So, there you very quickly are going to have to identify, what methodology more closely aligns with your investment philosophy. But then my experience is working with a lot of fundamental managers here and fundamental analysts is that the score can be a little bit abstract. And so what they'll want is also the raw, what we sometimes refer to in the ESG space as raw data, but it's effectively the company data. It's like, what did the company actually report? How did they report? What was their performance? Because that is actually a data element that they can take in a conversation with investor relations and then engage on that topic and actually understand why is the performance as such. You're saying you have a renewable energy policy, but the actual amount of renewable energies you've been consuming over the last 10 years has been going down, for example. Those are really things on which you can then engage. Then I would also just say, just to check the list, regulatory data. I don't feel like, regulatory reporting is a real differentiator as an asset manager. So I would tend to say that's maybe something I want to outsource even more than anything else. So regulatory data, if you want to market yourself in Europe, you need to meet those requirements. So just make sure you meet those. And then, this is maybe a good segue, but, I was referring to the alpha component of sustainable investment, right? What I've actually found is that you need to kind of be on top of what those policies are, transition policies in particular, that are getting, introduced all over the planet, like, subsidies for specific industries, the IRA specifically, right? But there's so many local examples all across the planet. So you probably want also to have somewhere, a terminal or whatnot that can easily give you access to that type of information. And then last but not least, carbon pricing, carbon markets, niche things like biodiversity. If you specifically have thematic funds or impact funds around some of these niche topics, you probably want to have a little bit more deep dive analytics around biodiversity, SDGs, and whatnot. So that's kind of like your checklist. And I would say that's the easy part. Because I just want to give one simple example and I'm not saying that the industry is as simple as it maybe used to be 5 years ago. I think we're in ESG 2.0 now, where, these models are evolving. But if you just take the simple, like take carbon data, you take carbon data and you say, I'm going to run an optimization strategy where I'm going to optimize for reducing carbon emissions. If you're not really smart about this, the thing that will happen is that your portfolio will consist effectively of healthcare companies and technology companies. And that is arguably not the best outcome to help us adapt, to climate change, lower carbon emissions, or mitigate carbon emissions, or adapt to a higher carbon world. And I'll give you an example. At Lazard, we have a fund which is called the Climate Action Fund, which specifically invests in companies that have a positive contribution on adaptation and mitigation. If I look at the average carbon intensity of that fund, it's higher than the carbon intensity of a broad market index. You can take any broad market index. And the reason for that is simply an allocation. It's simply allocation. It's allocated, more towards industrials and energy companies. And so by definition, these companies are carbon intense industries, but they're also the industries that come up with the best climate solution at this stage. I mean, that's what we will argue. But my point being is that carbon emission in itself is just a reflection of industry allocation in your portfolio. And so there needs to be a component there where we educate our customers as well and saying like, yes, we have a higher carbon intensity, but we're specifically investing in climate solutions. And that gives us allocations towards industrials and energy. So I don't want to, I could dwell on for very long on how we've built action methodologies and analytics around, avoided emissions, maybe, is a concept in the industry. But I just wanted to give it a quick and simple examples of how sometimes these simplistic metrics makes us believe that we have a very positive impact, but, it effectively, they're just a reflection of, industry allocation in a portfolio.
Great, thanks, Greg. That's a lot there to digest. Marcel, how can AI help? I mean, you can add to the challenges that Greg presented, but how can AI help here?
I think AI has a lot to offer. In fact, Clarity AI is built. The company was built on this premise that AI can accelerate the tracking and the understanding of all these sustainability aspects that Greg has mentioned. In fact, if we want to share, I think the other couple of slides to our audience, this is no surprise. All the challenges, right, that are listed here. You'll be intimately familiar as an investor, an investor yourself. How can you make sense of the information that companies put out and then try to map it to all these goals that Greg was mentioning, right? If you want to have a portfolio that has certain mandates. So that's where we come in. That's how, so we deal with the data that is coming from companies, both in sustainability reports, SEC filings, etc. Also, we follow the companies in the news, and I'll get to that. But then we're able to build up this raw data into methodologies and analytical frameworks. And we provide these tools so that you as an analyst or as a as a portfolio manager, can very clearly see how is it trending, and you can even define your own approaches. So if you jump to the next slide, this is really where AI comes in each of these areas, right? So we call it AI for data trust, because ultimately we want to make sure that the data and the analysis and the insights that we provide are really grounded in facts and verifiable data. So when we collect data, for example, we use AI to extract metrics, and you can imagine some of it is fairly easy because, okay, it's in a table, but sometimes it's in an infographic or it's part of the text. So we have some fairly sophisticated ML models that are able to extract this data. But at the same time, we still have some humans in the loop verifying and improving these models over time. We also use NLP, as I mentioned before, natural language processing, to not only extract this data from sort of these static PDF reports, but to actually process live articles. At this point, we're doing over 300,000 news articles a day that we scan for mentions of these thousands of companies that we track to see whether they're involved in any controversy or or whether they seem to follow some of the actions that they've set themselves, right? In terms of trying to basically see what they're actually doing, what they say they do. So that's in the data collection. We also use artificial intelligence for data completion, as I mentioned before, to increase the coverage of some of the unreported metrics. We can get very accurate estimates by looking not only at the industry sector, but also at company-specific attributes. And that's how we can, we go from 19,000 to 40,000 companies, for example, for some of the metrics. And then finally, we also use AI for data validation. As Greg mentioned, you also want to see whether like trends, right? You have the emissions for 2021, 22, 23. You want to see whether the trend, goes up, goes down. Our algorithms are also able to spot some outliers, right? Because sometimes there's actual factual mistakes in the sustainability report. Maybe sometimes the unit, instead of megatons, it's kilotons, and then there's 3 orders of magnitude difference. So we're able to have some checks of the ranges and the trend and the trends, so we can be very confident about the data that we put out into our platform. Also because every single data point is traceable to the origin. So you can actually click through and see the page in the PDF where a number is coming from. But it's not just this raw data, right? As Greg was mentioning, then we're able to aggregate this into metrics and like these frameworks. So we have different modules where you can see, for example, the ESG risk, or you can use the SFDR module or the EU taxonomy. It's all sort of different points of views from the same data to help you sort of have this narrative around your portfolio and track it over time.
Right. So yeah, I mean, Marcel, AI model output is only as good as the underlying inputs, right? And the fact that AI can actually help with the data collection management process, is a pretty significant value add. Kind of switching gears, how can AI actually also provide new insights, sustainability insights, or drive new use cases, right?
Mm-hmm. Yeah, that's also what we're working on next, which is not only do the analysis, but then also be able to provide some of the narrative. And here's where we're also starting to use generative AI, not just for the data extraction, but also to then kind of compile different data points into a narrative. Couple of examples are one where for example, what Greg was mentioning about exposures, right? If a company has exposure to tobacco or gambling, we can explain why, and not just with some numbers, but a little bit of a narrative. We use generative AI for that. But most interestingly, we're now working on, call it co-pilot, like analyst helper, some way of making sense of a portfolio that is able to then weave all these numbers and metrics into a bit of a narrative about how you're doing with regards to, for example, environmental or social or governance, and see a little bit of the trend, and also these very dynamics. So as soon as you adjust the portfolio, you can see how that changes. So that can be very useful if you need to explain to a customer, for example, how their portfolio is doing with regards to any of these sustainability areas.
Great, thank you, Greg. And anything that of what just Marcel just outlined, I mean, what kind of stood out for you, right, in terms of solutions?
No, look, I'm completely with Marcel on how AI will be transformative on the coming years, but like, I think it's really hard to have a glass ball and tell you exactly where we'll be in 2-3 years. But no, there's it starts timidly, right? Where you're starting to use LLM, in different types of use cases. So Marcel brought up a few things like, LLMs can be extremely practical for, data extraction. Fundamentally, one of the issues with ESG at the end of the day is that, if you ask me, what are the main data points that you use within ESG, I'll start with 50 and then I'll give you another 100. And then very quickly, yeah, but you know what? If you look at cement companies, you also have to take those into account. And so the problem a little bit with ESG, this is why sometimes it's referred to as a materiality map, right? Is like, what are the factors that are material to specific companies, to specific industries? But the problem is like, sometimes that is not even granular enough. Like there's so many idiosyncrasies at the company level even. And one of the benefits of LLMs is that they're extremely good at understanding context. And so I think one, Marcel gave some examples around extractions and whatnot, also around explainability that is maybe more exposed, for customers. But maybe one additional one that I will add is maybe, in the research process is, exactly that point of, we've been trying with ESG scores for 10 years, and, fundamental analysts still have a lot of qualms about ESG scores, because they see an abstract number and it's really hard for them to kind of like comprehend what that actually means. Well, another way to do it is, organize a bunch of data points, take a CSR report, and start asking questions using an LLM model, right? Because they can, take the document, they can also understand the context, the company, how it operates in which sector. And then with a little bit of prompt engineering, you can effectively almost create an engagement template, to go back to investor relationship and says, you tried to fool me behind those 250 pages of CSR, but what really came out of there is that, like at the example I was giving earlier, your renewable energy consumption has going down, even though you say that you have all these policies. So that's, I think, where LLM, can really help us organize the information to be context specific. That's another thing that I would say is really an interesting use case, something that we also experiment with.
Great, thank you. We just had a question pop up. Marcel, I'm going to direct this to you, right? So I'm at an investment firm, and I'm sold that the value that AI can bring, right? What do I need from a business technology process perspective to successfully roll out AI in my organization?
Right. Obviously, that's a very sort of broad question, but I would start with looking at what are some of the most kind of repetitive tasks that you find yourself doing, and see whether there's ways that could be automated, right? Obviously, I mean, obvious cases, reading sustainability reports is an extremely time-consuming task. It's a great idea if you have the time and you can follow a specific company, but if you're trying to follow a whole industry, you want to have some automated way, and then you want to go for a solution that you can rely on, right? That you can trust, and you can sort of verify the summary or the narrative that it provides you. That could be a small step. It's a little bit like, digital transformation, right? It's a big topic, but you just need to sort of take it one step at a time, see how we can help in your day-to-day.
Yeah.
Right. So a couple of other questions that have just come up. How can AI help regulators address greenwashing risk, right? Sounds, and I think, Greg, you mentioned this earlier. So maybe just define greenwashing really quick. And then, Marcel, Greg, how can AI help regulators here?
Define greenwashing. I wasn't expecting that one, but I mean, yeah, I mean, I know what it is. I can see it. I can smell it.
Yeah, Greg, I can take this one easily. In general, greenwashing is just presenting yourself, your company, as doing better in sustainability metrics and at what it actually is, right? And actually, a good example that our ML models, the NLP models, are able to do is we have all these policies, right, that we track. One of them is labeled wood, whether the wood that a company uses is properly sourced from a renewable source or is labeled by certified by a forest stewardship council, for example. And what some companies do is they say, we sustainably source all of our paper and board packaging to ensure net zero deforestation. Wow, net zero deforestation, that sounds great. But wait a minute, they just mentioned packaging. So this description applies to packaging, not to the actual product that they manufacture. So strictly speaking, they're not really following the label wood policy, right? So it's this kind of nuance that I do think that more advanced NLP models like we have now will increasingly be able to do and sort of, prevent some of this greenwashing.
Great, thank you. So Marcel, just staying with you, what is the difference between open and closed LLM models?
Yeah, great question. We just had debate yesterday. Our CEO was debating with Stuart Russell of UC Berkeley here at the debate at the World Economic Forum. Very generally speaking, is whether the model is a little bit like open source code. Can you see the code, or is it closed, right? Is it Linux or is it Windows? It's a nuanced discussion, right? What I would say is that the more transparency, the better. If you understand what data was used to train a model, then or if you can actually control that, all the better. Typically, you will not train a so-called foundational model because that takes huge amount of compute and data and money. But what you will do presumably is take a foundation model like Meta's Llama 2, which is an open source model, or the GPT-4 or 5 from OpenAI, which is a closed model, and then you can add your own data, what's called fine tuning, where you give examples from your domain about here's a document or here's how I would like it to be summarized, and then you can build your version of an LLM. It's basically a bit like in general, you don't necessarily want to have like a vendor lock-in, but it's good to explore what the different possibilities are.
Great. That's all the time we have. So we can certainly carry on this discussion. But thank you so much, gentlemen, for a highly engaging and educational discussion on how AI can not only help create a more sustainable world, but also help investors create better portfolios. So I'm going to hand it over to Anne to close it out for us.
Thank you, Raj. So that was such an interactive and fascinating conversation. Thank you so much, Gregory, Marcel, and Raj. Thank you to Clarity AI for sponsoring the event and to all of you for tuning in. We're going to be mailing all of you who have tuned in for the webinar a complete deck of information about these topics provided by Clarity AI. As well, we've recorded this webinar. We're going to be emailing that to you so you can share it with colleagues or re-watch it. So we thank all of you for being here today. Thank you for your time. This concludes our webinar. We look forward to seeing you at another CFA Society San Francisco webinar in the near future. Thank you, Marcel, again. Thank you, Greg. Thank you, Raj. Bye-bye.
Thank you. Bye.